Hey everyone, welcome back to Business Brain Rot, where we break down the latest earnings reports and what they mean for your investments. Today, we're diving into a rough day for Scholastic Corporation, that's NASDAQ. SCHL, the folks behind those epic school book fairs and Harry Potter vibes for kids. Their Q3 earnings just dropped, and let's just say, it wasn't pretty. Sales missed big, and the stock tanked 12.2% in after-hours trading. If you're holding SCHL or eyeing education stocks, stick around. I'll walk you through the numbers while we screen record this fresh Yahoo Finance article. Hit that like button if you're ready, and let's jump in. First off, a quick refresher. Scholastic isn't just any publisher. They're a global powerhouse in children's books, education tools, and media. Think Harry Potter launches, classroom magazines, and those nostalgia-packed book fairs we all rated as kids. But lately, they've been facing some headwinds in a tough market for print and edtech. This article from Yahoo Finance, titled Scholastic Report Sales Below Analyst Estimates in Q3 Earnings, Stock Drops 12.2%, lays it all out. Published just hours ago, it's got the raw data we need. As we scroll down, you can see their reporting for Q3 of calendar year 2025. Revenue clocked in at $225.6 million. All right, let's get to the meat. The numbers are a miss across the board on top-line stuff, but with a silver lining on the bottom line. Revenue? $225.6 million. That's down a sharp 4.9% from last year. Analysts were expecting $238.9 million, so they undershot by a whopping 5.6%. Adjusted earnings per share came in at -$2.52. Yeah, a loss, and 4.6% worse than the forecasted -$2.41. We're talking operating margins shrinking to -40.9% from -36.2% a year ago, and free cash flow burned another $100.2 million, up from $68.7 million last time. Adjusted EBITDA was -$55.7 million, which actually beat estimates of -$62.76 million. Margins at -24.7%. Not terrible in a seasonally slow summer quarter, but still red ink. Look here in the article, over the last 5 years, revenue's only grown at a 1.9% compound annual rate, and it's dipped 1.7% annually in the past 2 years. Education spending's tight, folks. The market didn't hold back. SCHL shares are down 12.2% right after the bell, with the company's market cap sitting at about $683 million now. Analysts aren't super bullish either. They see just 2.4% revenue growth over the next year, lagging the sector average. But hey, forward guidance is a bright spot, full-year EBITDA midpoint at $165 million, beating the street's $163.3 million estimate. Steady progress, as they say. From the top, President and CEO Peter Warwick had this to say in the release, and I'm reading it straight from the article here. Scholastic made steady progress in the first quarter of fiscal 2026, advancing strategic initiatives across all segments. The seasonally quiet summer period resulted in an operating loss consistent with expectations. Translation: they're pushing digital shifts and new content, but summer's always a ghost town for school-related sales. Fiscal 2026 Q1 lines up with this quiet vibe, so no big shocks. So what's the takeaway? This miss highlights ongoing challenges in print media and ed spending cuts, but that EBITDA beat and guidance suggest they're not capsizing. If you're a long-term holder, watch for holiday book fair ramps. That's their cash cow. Short-term? Volatility ahead with the stock dip. Compared to peers, SCHL's growth is sluggish, but at this valuation, it might be a dip buy if you believe in kids' literacy forever. There you have it, Scholastic's earnings in under 4 minutes, straight from the source. What do you think, buy the dip or run for the hills? Drop your thoughts in the comments, smash that subscribe for more earnings breakdowns, and turn on notifications so you never miss a beat. Thanks for watching, catch you in the next one. Peace.